Tupelo is one of the, definitely the most visited attraction in Mississippi.
If you're at all worried about filling your time when you retire, or even if you are already retired now, you should come somewhere like this, the 50 Plus show at London's Kensington Olympia. Plenty of stands with lots of ideas for what to do during what marketing types call your golden years. For example, there's always travel.
The picture in the far corner of the slide there is the cabin, basically, which was Elvis's boyhood home, and it's what they call...
There's holistic care.
And we're all about helping older people to really get the most out of later life.
Or there's some rather strange sounding medical procedures you could go to Bulgaria to get.
We offer any kind of the dental treatment, starting from the bone augmentation, implants, and also sinus lift.
Sinus lift?
Yeah, sinus lift.
Thanks.
Sounds a bit freaky, but we do it.
You do it. To do all of that, of course, you need money, and that is where our pensions come in, or at least should come in. And if you were at this show, there's no shortage of pension advisors and fund managers and all sorts of intermediaries to help you plan for your retirement. During this series, we're looking at how you pay for the city. Today, we're looking at how you pay for pensions. The question is the jumbo share of our pension provision going to the people who are supposed to be helping us? I've come here to meet Michael Rundle. He spent 35 years compiling dictionaries, but he found that 15 years of paying into a private pension fund really didn't do him much good at all.
When I started sort of winding down a bit in 2010, I had a really good look at it, and I was kind of horrified to discover that the amount in the pension pot was roughly the same as the amount that had gone in. I mean, it was a wee bit more, maybe 5%, but over that period, I just looked this up yesterday, the FTSE 100 went up, getting on for 60%, but the pension pot had grown very, very little in that period. My explanation is that, everyone's taking a cut, basically.
This series is about how you pay for the city, and it'd be quite interesting to find out how your pension money paid for the cities. But actually, in return, we'd quite like your help. It's not often you run across a sort of dictionarian.
A lexicographer.
Lexicographer, sorry, yeah, no, quite. We could do with your word power and your ability to explain definitions. So maybe you could help us along the way and explain some of the, well, quite frankly, baffling terminology and jargon in all of this.
I'd be happy to have a go, yes.
Our starting point for this investigation is a profound change in the way that we save for our pensions that's been taking place over the last 20 years or so. And, well, we're going to need the first of today's definitions from Michael, who's now comfortably installed in our dictionary corner.
Defined benefit is the income an employee will receive after retirement, which has been promised or defined by the company. An example is a final salary pension scheme provided by an employer.
That's the kind of scheme that most people who had pensions used to enjoy, but these days they become rarer and rarer. Now, mostly we have a different type. Michael?
Defined contribution is a pension where you don't know in advance how much you're going to get when you retire. This includes both occupational and personal pensions, like mine.
The move from defined benefit to defined contribution, which gathered speed during the 1990s, shifted the risk of poor pension fund performance from employers to the individuals. David Pitt Watson used to help manage the pension fund for BT. He recently wrote a report comparing our pensions with those available in parts of Europe.
The guaranteed income was going to be guaranteed by the employer. And the employers had said, look, people are living longer, I can't do that any longer. So let's just put money into an individual savings account. That doesn't give you such good returns because you don't have the advantage of saving collectively. In Holland, they've set up huge collective schemes to which everybody puts their money in. Those big collective schemes are structurally much, much more efficient and are lower cost than the way in which we do it. Those costs ramp up over time, and as a result, the Dutch end up with much better pensions. If a typical Dutch and a typical British person today at the age of 25, with the same life expectancy, save the same amount each year, retired on the same day, and they save the same amount each year for their pension, the Dutch person would get a pension that was on average 50% higher than the British person. 50%.
As we've seen repeatedly so far, complexity and layers in financial services mean costs and fees for the intermediaries and disappointing returns for the investors. Finding this out might make you feel like ringing up your pension provider and asking for a list of fees being taken out of your pension. But can I suggest that you don't bother, at least not until you've heard from Chris Sear. He's an independent industry analyst. He tried doing just that. First, though, we need a jargon definition from Michael.
IFA is an independent financial advisor.
Thanks, Michael. Now, here's Chris.
I rang up the help desks and I started asking questions about charges, and I went through the usual pantomime that one goes through, which is, well, the annual management charge is X. Now, because I'm aware of the problem, I said, well, does that include all of the costs? And eventually dragged out of the person on the other end of the phone that there were additional costs. Do you know how much they are? Well, we published these, and last year they were X, Y, and Z. Okay, fine. Are there any other costs? Can you give me an idea of my trading costs, please? No, we can't give you any idea of those. You need to contact your IFA.
So let's see, the owner of the pension couldn't find out who was taking slices of his future. Now, had that happened to you or I, we may have just slammed down the phone and taken out our frustration on our nearest and dearest. But, well, Chris is built of sterner stuff. He thought, if I can't find out about my pension fund costs, I may be able to find out about the costs of funds managed on behalf of public sector employees using freedom of information. You might remember from last week that Chris had already unpicked the way ISAs are sold and found 16 layers of intermediaries all charging fees. So he fancied his chances of decrypting pension fund costs.
What I found interesting was, given that it's probably the same structure as this retail fund ISA market, do they use the same terminology? No. It's even more opaque than the retail fund market. And you can try and dig and get costs on this market, but it's virtually impossible to find any.
The local government pension scheme is defined benefit. That means if there's not enough money in the fund to pay out, the employer, also known as the taxpayer, has to stump up the difference. But it shares one core problem with the defined contribution saver. Because the scheme is made up of lots of small funds that incur charges individually, there are lots of untapped economies of scale that keep fees high. The worry for members of such schemes is that if there is a shortfall and it's too big, they could end up being politically unsustainable. And from 2016, any fees above an agreed level will have to be met by increased contributions from employees. For that reason, the union Unison started doing its own digging on costs. Remember, we're only talking about public sector pension funds, not because they are particularly exceptional. It's just that they're the only ones for which we can demand to see the books. Here's Colin Meach of Unison.
Fund management costs are now running at £473 million last year. Those costs went up 14%, but the value of the assets only went up 4%. So you've got a distortion. Generally, the fund management charges are going up because they're managing larger volumes. That's simply how it works.
So they've got more expensive?
Yes, more and more expensive. And the return has got worse.
But at least for local government pension funds, there is a group of people who are supposed to be keeping an eye on costs on behalf of pension fund members. They're called the trustees. But Colin Meach of Unison says they are often rendered ineffective by a combination of complexity and generosity.
There is something to do with fearing looking like a fool. If you're a fiduciary trustee and you're sitting there on behalf of other people, do you think you're going to admit that you don't know? There was a colleague of mine who became a Unison rep on one of the big funds, and he's a red wine connoisseur. And he went to the meeting and he said it started at 9:30 and finished at 12. And he thought that was a bit short to discuss a £10 billion investment fund. You know, that's a bit short. But lunch was served and sponsored by the fund manager. And he said there wasn't a bottle of wine on the table less than £100 in value. So he said it looked really good. Fund manager paying for all this. But of course, you're the one paying for it. You're buying the lunch, but you don't know you're buying the lunch.
So as they sip their Chateau Lafite, what should pension trustees be looking for? Well, one nasty that can drain a pension fund faster than you can say bottoms up is churn. Michael, please explain.
Churn is the excessive buying and selling of stocks in search of returns.
Chris Sear looked at churn rates of local government pension funds.
I have data here that shows that this fund has traded over the past year £100 million worth of equities, at a commission of 0.1%. So they've taken 0.1% of the £100 million traded. That might seem very small, but if the fund that is being turned over is only £10 million in size, that means that they have bought and sold everything 10 times in a year. So you haven't been charged 0.1%, you've been charged 10 times 0.1%, which is 1%, plus associated stamp duty. So all of a sudden, in a high churn fund, you have some significant costs of trading if that churn is very, very high. And I found some notable instances where it was very high indeed. On average, actually, the average churn was 120%, which means that a mixture of what should have been active and passive funds were being turned over 1.2 times per year, which is very high.
But what if all this churning means that your pension performs better, more than cancelling out the higher fees? Well, not so, says Dominic Hobson. He's pored over the data from the local government scheme and found no correlation between high churn rate and high returns.
When we plotted the commissions paid against the returns earned, we couldn't draw a straight line through it. The data was all over the map. You could have churn of hundreds of percent and be getting returns of minus 20, 30, 40, 50%, or you could have churn of 10% and be getting positive returns of up to 50%. There is no correlation between, in the data, the amount of turnover and the returns that you get.
The industry used to publish data on fund churn, but no longer. The Investment Management Association says the figure is potentially misleading, and in any case it's working on coming up with a single cost figure for each fund that would include churn fees. Daniel Godfrey is the Chief Executive of the Investment Management Association.
I think this is one of the reasons why we need to get to a sensible measurement for what portfolio turnover is, because what we don't know underneath that is what the profile of that fund is, what its liabilities and its assets are. You just have no idea from looking at those bare figures. And so I think you just all need to be a little bit cautious about drawing major conclusions. I saw that research and I think it's clearly legitimate to ask, what is this turnover? Is it adding value to the end clients? And if it's not, why are we doing it? We're not doing a good job. And clearly, there's a very heavy responsibility on the asset management industry to do the best possible job it can, because it's doing very important things for real people.
But we have a system that rewards activity but not results.
Well, the investment manager doesn't make any money from turnover. The brokers that we interact with do, but it's not in the interests of the fund manager to overtrade and spend more money, because all that will do, if it's not generating performance, is diminish performance. If the fund is smaller, the fund manager earns less fees. So I would say the opposite is the case.
Some argue, though, that high-churning fund managers can receive valuable benefits from brokers in return for putting all that business their way. But even if there is no incentive for the fund manager to milk churn...
Oh, very good.
Oh, thanks, Michael. They also have other ways of taking a slice out of your investments. One of them is called stock lending, and, well, because Michael is now being a bit rude about my jokes, let's get Gina Miller of the True and Fair campaign to explain.
Oh, sorry, David.
It's too late now.
If you bought a new car and you went to bed at night knowing that your new car is on your drive, stock lending is like somebody comes along with a spare key, takes it out for the night as a taxi driver, earns income from your car, and you have no idea in the morning that it's gone or it's been used during the night. So what happens in stock lending in investments is that the fund manager might then lend out the stocks you've invested in.
And of course, when the fund manager lends out the stock, the borrower pays them a fee. Now, you might think that seeing as these are shares which belong to the pension fund that are being lent out, well, the fee would go to the fund. But some fund managers may have been grabbing up to 100% of the fee for themselves. Many take a huge cut. This has led to an ongoing legal battle in the US. But even if a pension fund was receiving 100% of the stock lending fees, is it really in their interest to do it? Traders usually borrow shares in order to sell them, believing they're about to go down in value. This is what's called short selling. Here's the writer and economist John Kay.
There are two problems here. One is if the intermediary is collecting the fee for stock lending rather than you, the underlying owner of the security. There's a rather obvious conflict of interest there. And the second question you're raising rightly is it really in your interest to lend stock you hold in order to facilitate someone else betting against it.
But Daniel Godfrey of the Investment Management Association says that stock lending can help pension fund managers make money for their clients.
If you are a fund that is holding these shares on a long-term view, you believe that this stock has fundamental value, and therefore any short-term movement in price caused by a short-term trader shorting the stock is irrelevant to you. So what you're asking yourself is, can I earn a fee for my clients which will enhance their returns through undertaking this transaction? If the answer is yes, it may be a good thing for me to do because I don't mind if there's some shorter term volatility as a result. Secondly, there are very clear rules now since February which ensure that any fees earned from stock lending do go to the fund. The only thing that can be deducted is costs incurred in undertaking those transactions. So that's an issue which is gone, so it's not really something that we need to debate anymore.
However, this may not be the end of the debate. The new rules state that fund managers can only retain reasonable costs of stock lending and must pass on all other fees earned to the pension fund. The definition of what this means in practice is a little bit grey. And one fund manager we spoke to told us they would continue to keep 40% of the proceeds. For our next example of how you pay for the city, we have to look at another part of what the pension industry rather amusingly calls the value chain, or, as it can look to the saver, yet another intermediary taking a cut.
Around me here at Canary Wharf are plenty of household name banks. There's Barclays over there, there's HSBC. But I'm standing outside one bank you probably have never heard of. It's called State Street. It sounds perhaps more like the name of an urban dance troupe, but it's actually one of the world's largest custody banks. There are plenty of others like Bank of New York Mellon and Northern Trust. They arrived on the scene because people stopped trusting fund managers. Their core business is to provide safekeeping for the assets owned by pension funds. In return, they charge a fee, but that fee is often tiny, sometimes even non-existent. Fantastic, you might say. At last we've found something in this whole system that's good value. 3 cheers for the custody banks. Except, well, it's not quite like that. Here's Dominic Hobson of Investor Data Services.
How do custodians get paid for safekeeping and asset servicing duties if they're giving those away more or less for free and sometimes for nothing? Well, they do what banks always do. They lend the assets they have in custody. Those assets are partly cash, so they collect a spread on the cash. They're partly securities, so they get a fee for lending those securities. They also get paid through foreign exchange transactions where they can take a spread between the price at which they buy the currency and the price at which they sell it. To give you an example, when pounds are used to buy dollars, the actual rate might be £1 buys $1.50, but the custodian charges the client $1.48, i.e. each pound is buying that client $1.48, not $1.50. Now that 2 cents doesn't sound like much, but on £1 million it amounts to $20,000.
And remember, that's $20,000 that comes out of the pension fund. At its worst, it's alleged that some custody banks deliberately selected the most expensive possible exchange rate to give to the client, while actually conducting the trade at a far better rate. The difference is pure profit. As well as making money from stock lending and foreign exchange, the custody banks have also got themselves a lucrative little sideline in something called transition management. Michael, please give us another definition from your dictionary.
Transition management is when a pension scheme or other fund changes its investment strategy, for instance when replacing one fund manager with another. Transition management is the overseeing of this process to make sure that it's done in a cost-effective and timely way.
Thank you. In some cases that have come to light, State Street managers added hidden margins on these transitions. It cost some of their clients, including the Royal Mail Pension Fund, millions before it was spotted. In one email referring to a contract with a large sovereign wealth fund, a State Street transition manager said the margin would mean they could, quote, back up the truck, presumably to fill it with money. We found out about that email when we obtained this document. It's an employment tribunal judgment. State Street had fired an employee when one of those hidden margins, costing the Royal Mail Pension Fund an extra $3 million, came to light. the employee alleged wrongful dismissal, saying he was a scapegoat. He lost, but not before this extraordinary exchange between the ex-employee, Edward Pennings, and a tribunal lawyer.
You told the Royal Mail that you had made only £227,500 and some £400,000 as the only income from the transition, didn't you?
Yes.
It is a lie, isn't it?
No.
But it is not true, is it?
No.
So why isn't it a lie?
Because I didn't think I had to tell the truth.
The tribunal judge called this, quote, a truly astonishing moral precept. But the man who helped discover the $3 million in hidden profits says it's almost impossible for trustees to find out the true cost of this process because only the transition manager knows what the market is doing when the trade happens. Here's Graham Dixon from Inalytics, who did the sleuthing.
You could have had the pension fund doing due diligence, getting the best offer for doing the transition, but actually the amount that they've been charged has been a very different figure. There would be a margin being charged between what was being bought and sold and what was being booked to the client, and that margin would be invisible. It would be of concern to a client because it would be very difficult for them to detect and very difficult for them to quantify what that remuneration was.
In a statement, State Street told us that they had reported the problems in their transition management business to the regulator themselves. This, they said, was an isolated incident and in no way indicative of their business practices. The UK regulator, the FCA, though, is so worried about this seemingly murky world that they are in the middle of an investigation into the ways that custody banks make money. But is another layer of oversight or regulation really the answer? John Kay's review of equity markets concluded it's not more layers we need, but more trust.
The way we've constructed regulation, which is around the basis that there is very little trust around or justified in this industry, means that every time you create a layer of oversight, you need another layer of oversight to oversee the overseers. It's the who guards the guards conundrum, and that leads to who guards the guards to who guard the guards. And this can go on and on and on. And I'm afraid it has gone on and on and on. The only way to deal with this, actually, is to put back trust in the system. But that's something that requires a long period of time and a big culture shift to achieve.
And the price of this lack of trust is paid by every pensioner and every saver. Our money is being chipped away, says John Kay, squandered on layers of oversight and complexity until there's hardly anything left.
So in the end, we can see the whole of the underlying return that is potentially being earned for savers being absorbed in the costs of intermediation. The truth is, in the last decade, we haven't been so far from that situation.
Next week, we're looking at how you pay for the city through derivatives and high-frequency trading. But we should perhaps leave the last word today to our man of words, our lexicographer and disappointed pension saver, Michael Rundle.
If you could sum up your experience or your thoughts, really, about the pension fund industry in a single word, could you give it to us?
I mean, let's just say...
Please, Michael, this is Radio 4.
The reporter in How You Pay for the City was David Grossman. The programme was produced by Phil Kemp. Next week, as David says, the series explores the complex world of derivatives and investigates how investors are paying for the super-fast computerised modern trading now dominating world markets.